Rahul Srivastava addressed has been, addressed in the Chief Economic Advisor's report as well. There's been an impact, a negative one, on ITC because, tobacco and tobacco product companies are going to be subject to GST at a demerit rate. We've discussed the highlights. Now let's go across to Rajeev Dimri, leader Indirect Tax at BMR Associates, joining us from the Delhi office of BMR Associates. Great to have you on the show, Mr. Dimri. This is Manvi here in the Delhi studio. You know, I bet you've spent the last couple of days, even though it was the weekend, discussing the recommendations of the Chief Economic Advisor with your colleagues and your clients. What's noteworthy in those discussions? What's the reaction per se?
Well, at the macro level, at the outset, I think suggested rate of 17 to 18% is a great news. It is a huge welcome because there were, in the past numbers floating up to 27%. In the last in-part committee meeting, a number of 25 was at least in the press. So from there, a 17, 18% standard rate is, to begin with, a great news. This suggestion to remove this 1% is also a step in the right direction because the whole industry was opposed to this 1%. So on an overall basis, the rates that are coming out in the recommendations are great. I would only make two comments from a rate perspective. You mentioned about the demerit rate at 40%, which I think, considering a standard rate of 17% and a lower rate of 12%, the swing on the demerit rate seems very high to me. So that's one comment. It does impact a few industries to begin with, but the bigger concern would be that with this rate so high, what stops over a period of time other products being pushed into that basket, which we have experienced in the past in the VAT regime. So that 40% is certainly on a very high side. So that's one concern that the industry would have. The second, on the lower rate of precious metal, which currently is at 1%, a rate going from 2 to 6% might also be a concern in some quarters because, dealing with precious metal, you're always concerned that are you going to push the trade out of the mainstream into the parallel trade. So a rate jump from 1, which may go up to 6, could be an area of concern. But other than these two, the headline news is a great welcome.
That's a very succinct summary, in a sense, Mr. Dimri. Now, in terms of the details and the fine print that is going to be available with all of us today, hopefully shortly, what will you be looking out for? Well,
the whole 17-18% is based on a lot of assumptions. There are talks about petroleum products being in it. There are talks about real estate being in it. So, supposedly it's a 100-page report. So a lot of data and a lot of analysis and a lot of assumptions must have gone into this 17-18%. So there's a huge wealth of data to be analyzed, not just from now, but, this is just the beginning of the whole process. As you're aware, the petroleum sector, the electricity sector, the real estate sectors have to be folded in, and therefore it will be a wealth of information to be analyzed in that report. 17-18% is a good place to start, but what's the overall projections and predictions? Some trend on that would be of great importance. So there is a whole lot of data to be analyzed.
Fair enough. I'm going to go back to a couple of points that you raised and urge you to, use your vast understanding of India's tax system to highlight the risks. Now, you said, look, this demerit rate of 40%, A, the swing seems high, but B, there's a tendency to put other things into that category as time goes on. What is the past experience that is making you wary on this demerit rate?
Well, if you look at the time when when VAT was introduced across the states, the rates were effectively 4% of items of mass consumption. The standard rate was 12.5%, and for select few, the rate was taken to 20%. Take an example of aerated beverages. They were pushed in the last 2-3 years to the 20% bracket from 12% bracket, because once the bracket exists, it could be state's prerogative to simply move an item from bracket A to bracket B. And that's what we have seen. Many items have moved. So to again take another specific example, cellular phones were kept at 4%. All IT products were kept at 4% when the VAT began back in 2004, 2005. Over time, states have moved smartphones into a 12, 13, 14% bracket. Some states have come up with some sort of borderline saying phones above 10,000 will move to a higher bracket and phones below 10,000 will remain at a lower bracket. So these are just two examples at the top of my mind, but there are several such instances where states have used that higher bracket to move products, from the standard rate of 12.5 at that point in time to 20%. That's the concern that the industry would have, that a product may start at 17, 18% and suddenly maybe move to 40%. Now that's a material change in the rate of tax. So I think that's on the higher side, and the fear of the industry would be well founded.
Okay, I'm going to ask you to rewind on another matter, and you mentioned that with the rate going from 1% to the 2 to 6% band on precious metal, there's the risk of the parallel trade building up. Now I'm going to present a slightly naive hypothesis, and feel free to puncture it. This is, in a sense, a discretionary spend, and a higher taxation rate, intellectually seems permissible. What, again, historically, have you seen which suggests this movement into a parallel trade when you have moves like this one, a higher tax rate on precious metal?
So, fair point. I don't disagree with the point that you make that, if these are discretionary spend and more conspicuous consumption, why should they not pay their own share of tax? I fully agree with that. I'm not betting that these products ought to be at a lower rate. There was a philosophy around this 1% at the time when this 1% rate was introduced back in 2004, that when we deal with precious metal, these things keep circulating. It is not something that gets consumed and gets destroyed. These items keep getting recycled, and therefore they re-enter the economy multiple times. So that was one philosophy around it. And second, keep a rate that there is no incentive to evade. We've seen in the past where if one state moved that to 2% or another, the trade shifted because a lot of trade could happen simply on paper. And therefore, I am not saying that that rate is unfounded or undesirable. I'm only raising a concern that we are dealing with a product range which is highly susceptible to a parallel market. Moving a rate from 1 to 6, while maybe logically correct, it is a concern at a time when we're trying to bring more economy into the mainstream and going against black market, black economy in so many other ways. Would this be a careful calibration that is needed? That's the only point I'm making.
Fair enough. And I knew it was unfair when I asked you that question, because I knew that, you weren't sort of defending the rate per se, just raising the risk. What about the careful calibration that's going to be needed in folding in real estate and petroleum? Are there any thoughts and concerns that you can already, anticipate, want to share with us, or is it premature to start talking about that?
I think that's premature because that's not just a rate issue. A whole lot of other things need to fold into place. So simply a rate recommendation can't start, to speculate on bringing in real estate or bringing in, other sectors like electricity. So I think that's a much bigger area to talk about rather than just a rate strategy on that.
Okay, I'm going to ask you to assess sentiment right now because, again, your interactions with your colleagues, your clients, is sentiment or anticipation now building up that, GST could make it through this session of Parliament? And I ask that because I don't know if you caught my colleague Rahul Srivastava's report a few minutes ago. Highlighted the fact that, look, we got 13 days of Parliament left, of which only 11 really can be applied to GST. But the good news is that, it's been listed for discussion in the Rajya Sabha, and 4 hours of discussion time have also been allotted to it. I'll get your thoughts on that and then ask you to assess the preparedness, not just on the government side, but on the corporate side for various rollout deadlines come April 2016.
Well, I think the expectation is very high on account of various things that have happened, starting from the fact that the government came out and awarded the contract on the GST backbone to Infosys. So that happened in August, September. Then, of course, the political developments, the meeting between the opposition and the ruling party, the recommendations. So a series of steps, including a draft GST bill that is now floating. It's on the official website of UP government. So various steps are proving in the right direction. I think the sound bites have also changed. So there is a huge amount of expectation that it could go through. I personally would think, and I think the government itself has ruled out April 1 as a date. So nobody is expecting it to be April 1, 2016. There are, expectations that this might be in the later part of the year, maybe October, November of 2016. So April certainly is, not a possibility at all. From the government preparedness, you do have to realize that government needs to be ready only with few things, things like registration, things like payment, things like return format. And those reports were released by the government some time back. That ostensibly is part of the contract that they have with the Infosys. So I think the government is doing well enough to be ready for the things that they need to be ready with. The level of preparedness for the corporate India needs to be that much higher on the start date of GST, and I think that's where not much of action happened at the corporate India level in the past. I do believe that these current developments are prompting a lot of corporates to take stock in-house, but they'll have to do a lot of hard work in the next few months to be GST ready. Larger the companies, their whole IT system, their whole pricing policies. So the bulk of the preparedness has to happen at corporate India, and I do hope that they will, take this in the right earnest and prepare for it.
Rajeev Dimri, I'm going to leave it at that. Really appreciate your time and your insights here on NDTV Profit, and look forward to speaking with you more frequently as the details and the mine of information that's going to be contained in that report will and shared. Thanks very much.
Thank you.
We're going to take a break. After that, Jagdish Khattar, Chairman and Managing Director at Carnation.